What if I told you that you don't need to pick winning stocks to beat 90% of investors in 2026? In fact, most beginners trying to get rich with stocks end up doing the exact opposite. They lose money chasing hype. But there's a simpler strategy quietly used by millionaires, hedge funds, and even Warren Buffett himself. It's called ETF investing. And today, I'll show you the best ETFs for beginners in 2026 that can help you build long-term wealth in the US stock market without stress, timing, or guesswork. Stay till the end, because the last ETF is the one most beginners completely ignore, and it might be the most important one for stability. Before we jump in, understand this: 2026 is not 2010 anymore. We're in a market driven by AI stocks dominating indices, high interest rate cycles, volatile tech bubbles, and global uncertainty affecting US equities. So blindly buying popular ETFs is not enough. You need the right mix of growth, stability, dividends, and diversification. And I'm going to break it down into a simple beginner-friendly ETF portfolio anyone in the US can start with. ETF number 1. VTI, Total US Market ETF. First up is the foundation of almost every long-term portfolio. VTI, Vanguard Total Stock Market ETF. This ETF basically owns the entire US stock market. Apple, Microsoft, Amazon, Tesla, plus thousands of smaller companies. Instead of betting on one stock, you own everything. Why beginners love it? Extremely low expense ratio, instant diversification, long-term historical growth around 8 to 10% annually. Think of VTI as your core engine ETF. If you only bought one ETF in your life, this would still be one of the safest choices. But here's where most beginners make a mistake. They stop at VTI and miss out on sector-level growth that can massively boost returns. Let's fix that. ETF number 2. QQQM, Nasdaq Growth ETF. If VTI is the whole market, QQQM is the high-growth tech engine. It includes Apple, Microsoft, Nvidia, Google, Meta. Basically, the companies driving AI, cloud computing, and digital infrastructure in the US. Why it matters in 2026? AI is not a trend anymore, it's an economy shift. But warning, QQQM is more volatile than VTI, so think of it like VTI equals stable foundation, QQQM equals aggressive growth booster. ETF number 3. SCHD, Schwab US Dividend Equity ETF. Now let's balance growth with income. This ETF focuses on strong cash flow companies, consistent dividend payers, financially stable US businesses. Examples often include Coca-Cola type companies, energy giants, consumer staples. Why beginners ignore it? Because it feels slow, but here's the truth. Over time, dividends become your passive income engine. SCHD is for stability during crashes, reinvestment compounding, long-term income building. If VTI is growth, SCHD is your sleep peacefully at night ETF. Now you might think, okay, I've got growth, tech, and dividends, I'm done. Not even close, because there's one asset class beginners almost always ignore. And it becomes critical when markets crash. ETF number 4. BND, Vanguard Total Bond Market ETF. This ETF does something simple but powerful. It protects your portfolio when stocks fall. Bonds stabilize returns, reduce volatility, provide income when stocks crash. When the stock market drops 20 to 30%, bonds often hold steady or even rise. Think of BND as your financial shock absorber. Beginners ignore bonds because they want fast growth. But professionals use bonds to survive downturns. Now let's combine everything into a simple beginner ETF strategy for 2026. A balanced US portfolio could look like 50% VTI, core market exposure, 25% QQQM, growth and AI exposure. 15% SCHD, dividend stability. 10% BND, risk protection. This is not financial advice, but a simple framework beginners use to reduce emotional investing mistakes. The goal is not to get rich overnight. The goal is to stay in the market long enough to let compounding work. Here's what most beginners never understand. The biggest enemy in investing is not the market. It's emotional decisions. Panic selling, chasing meme stocks. Timing the market. ETFs remove that emotional pressure. You don't need to predict winners. You just need to stay invested. And over 10 to 20 years. That's what builds real wealth in the US stock market. If you want, in the next video I can break down Best AI ETFs for 2026. Or, Top 5 High Dividend US Stocks for Passive Income. Or a $1,000 beginner portfolio strategy step by step. Just comment below what you want next. And if you're serious about building wealth in the US market, subscribe to Wall Street Pulse, because we simplify Wall Street into real strategies that actually make sense.